At first glance, the story of Marvell Technology looks, well, incredibly simple. AI demand is literally exploding all over the globe. Marvell is heavily involved in supplying the crucial infrastructure for it, their revenue is growing, and major tech giants are spending absolute fortunes on AI. So why wouldn't you just go ahead and buy Marvell stock? Well, because there is a massive problem hiding right underneath that beautiful growth story. The market doesn't reward companies simply because they're growing, it rewards them when they grow faster than investors already expected. And when expectations get this sky high, we have to figure out just how much of the future is already priced in. Welcome to this explainer. Today we're diving into one central question: is Marvell still a buy?
To really understand the stakes here, you have to look at this number, 180%. That is roughly how much Marvell Technology's stock has surged in 2026 alone. This isn't some steady, gradual climb we're talking about. This is a dramatic, explosive surge, totally driven by the promise of the AI revolution. And after a stock has run up this much, the expectations fundamentally become the story. We aren't really asking if Marvell has an AI opportunity today, because it clearly does. We're asking if the underlying business can actually catch up to this massive, massive momentum.
And that brings us to the exact number the entire market is waiting for right now: $2.7 billion. That is the midpoint of Marvell's revenue guidance for the upcoming quarter. It's the hurdle they've set for themselves, and it's the ultimate benchmark investors are going to use to judge if this AI hype is translating into hard cash fast enough.
Okay, let's dive right into part one, the 180% mystery. Why exactly has Marvell exploded like this? To answer that, we have to look past the soaring stock price and really look at what they actually sell. It's a super fair question, right? When most people think of the whole AI boom, they immediately think of consumer GPUs, the kind of chips NVIDIA sells. But that is not Marvell's primary game. Actually, Marvell operates much deeper inside the guts of the data center infrastructure. They're focused on the plumbing, networking, connectivity, optical components, and custom silicon. They don't actually need to dominate the entire AI accelerator market. They just need to profit from the massive infrastructure required to surround and support it all. Let's move to Section 2, the custom silicon bet, deep inside the data center.
So this entire strategy revolves heavily around custom silicon. It's an area where Marvell is quietly citing over 50 custom AI opportunities across more than 10 different customers. Let's see how this builds into actual cash flow. It starts at the very top with a hyperscaler. Think of your massive cloud providers. They desperately need custom accelerators for their data centers. That demand flows directly into Marvell's technology pipeline, which eventually translates to real revenue and future design wins. It's a brilliant business-to-business pipeline. But, it also means Marvell relies heavily on massive, multi-billion-dollar corporations, keeping their foot firmly pushed down on the spending gas pedal.
Section 3, the $2.7 billion test. Earnings versus the hype.
Let's interrogate the hard financial evidence backing up this infrastructure narrative. Because, let's face it, eventually the story has to meet the spreadsheet. In Q1 of fiscal year 2027, Marvell reported revenue of $2.418 billion. That's a 28% year-over-year growth rate. Now, 28% sounds incredible, right? It shows the AI infrastructure story is absolutely translating into real financial results. But remember that 180% stock surge we talked about. If the stock rises significantly faster than the actual business grows, the valuation itself becomes the problem. Can the earnings truly catch up?
Which leads us straight into management's specific guidance for Q2. They're projecting revenue of $2.7 billion, give or take 5%. They're also guiding for non-GAAP earnings per share, which is essentially their baseline profit metric of 93 cents, plus or minus 5 cents, and GAAP EPS of 37 cents. Keep in mind, these aren't just some random analyst forecasts. These are the company's own expectations heading into their next report.
Now here is absolutely the most critical question you can ask yourself as an investor. What happens if Marvell simply meets this guidance? Like, in a normal market, hitting your targets is a great thing. But when your stock is priced for absolute perfection, merely meeting expectations might not be bullish at all. The market might actually demand a massive beat just to keep the stock price where it is today.
Now, what's really interesting about this is what these numbers tell us about Marvell's profitability. Revenue tells us how much Marvell sells, but margins? Margins tell us how much economic value they actually get to keep in their pockets. In Q1, we saw a GAAP gross margin of 52.1% and a non-GAAP gross margin of 58.9%. Honestly, these are really healthy margins.
But the execution risk here is huge, as Marvell rapidly expands its custom AI silicon operations and scrambles to scale up to meet all these massive new data center demands. Can they really maintain these margins, or will the sheer cost of aggressively scaling into this new AI frontier start eating away at their profitability? Speaking of massive scale, we literally have to talk about Google. Reports indicate that Google could place potential custom product orders with Marvell worth up to $120 billion through the year 2033. To put that into perspective, that is roughly the GDP of a small country. Furthermore, there are about 59 million Google-related Marvell warrants with an exercise price reported at $206.58. This is a staggering, eye-watering level of potential business.
So the crucial point is this: we absolutely need to pump the brakes. That $120 billion number is enormous, almost too enormous. But potential orders are not the same thing as recognized revenue. The market still has to determine exactly how much of that $120 billion actually materializes, when it materializes, and at what margins. It's a massive clue to Marvell's potential, for sure, but it is not guaranteed money in the bank today.
Section 4. Evaluating AI spending risks. Let's look at the durability of this demand.
Evaluating these broader risks means taking a hard look at the competition. Because Marvell isn't exactly building this future alone, Broadcom has officially entered the chat. Broadcom brings massive scale, its own custom accelerators, and super deep relationships with hyperscalers. Marvell is countering that with custom silicon, optical connectivity, and expanding its AI exposure. The question isn't necessarily who wins and who loses the whole thing, but rather, can Marvell capture enough of this custom chip market alongside a giant like Broadcom to justify its current hype?
Let's zoom out to the macro risk for a second. Every AI infrastructure company faces the exact same problem right now. Who ultimately pays for all this? Currently, hyperscalers are spending billions, but eventually, investors expect those massive investments to generate actual returns. If AI spending by these few, highly concentrated customers slows down even slightly, Marvell's growth expectations could absolutely plummet. The market doesn't need AI spending to collapse entirely. It merely needs growth to slow down just enough to disappoint those sky-high expectations. That right there is the danger of customer concentration.
A super quick aside for any retail investors looking at this stock. Marvell is fundamentally a growth and infrastructure semiconductor story. Period. If you are looking at Marvell for steady income and dividends, you are simply in the wrong place. This is a play for growth, capital appreciation, and taking on the associated roller coaster risks of the AI boom.
Part of that whole growth strategy involves really aggressive expansion through acquisitions. Marvell's fiscal 2027 guidance actually incorporated the integration of Celestial AI and XConn technologies. The big question here is whether Marvell can smoothly turn these acquisitions into organically profitable growth, or if these moves just make growth way more expensive. Integration brings dilution, amortization, stock compensation, and higher operating expenses that directly hit their free cash flow. Section 5. Is Marvell still a buy? Let's bring it all back to valuation.
And this brilliantly illustrates how you kind of have to walk through this valuation pipeline systematically. We've seen the 180% surge, the massive Google opportunity, the custom silicon bet, and the heavy risks of high expectations. So how do we match that against reality? You start by looking at the current stock price, which obviously dictates the market cap. You compare that to the actual revenue and the forward earnings per share. And finally, you weigh all of that against the expected growth.
Which leads us to what might be the single most important investment question you can ask. The question isn't, is Marvell a good company? Actually, scratch that. We know it clearly is a good company. The real question is, what does Marvell literally have to earn 5 years from now for today's valuation to make any sense? Is Marvell's future good enough to justify the massive price tag you have to pay today?
Let's wrap this explainer up with our final investor scorecard. We know the AI exposure and data center opportunities are incredibly strong. The potential Google partnership, highly significant. And gross margins, they are healthy. However, the reliance on macro AI spending and customer concentration present very high risks. The competition, notably from Broadcom, is also significant. But the absolute biggest red flag is the valuation, which absolutely must be justified by near-perfect execution. We know what they sell, we know the opportunity, and we know the risks. So I'll leave you with this final provocative thought. We all know the future of AI is massive, but when a stock is already up 180%, is that future actually worth the price?